Is it true? That is the question. There's a lot of marketing that's going on and a lot of kind of mass hysteria that's happening in the market because people are publishing that people now with worse credit and worse down payments are going to start getting better rates than people with the best credit and the best down payment. There was an article even published this past weekend in the Wall Street Journal claiming that. There's things that are going around on TikTok. So let's separate fact from fiction and let's do a little myth busting. So when we talk about that, it's all based on changes that are actually happening to Fannie Mae. Fannie Mae prices out loans at different areas depending on what your down payment is and what your credit is. They call them loan level pricing adjustments. So there was actually a change that was going in play. It is happening on May 1st for any new loans that are being invested in by Fannie Mae. So that's what's causing the uproar is we're obviously just about to hit May 1st and everybody's very concerned about that. So what people are gravitating to is this chart that they've seen. So this chart shows the differences. It's a whole grid, as you can see. I won't go into too much detail here, but it's a grid of adjustments. So what they're looking at here is saying, well, hold on, if I'm somebody doing 25 to 30% down, I get a quarter worse rate. But if I was only doing, say, 15 to 10%, 10 to 15% down, and my credit was a 740, I get a half better rate. So my pricing is improved in that scenario. No, it's not. I've even heard somebody say, well, I'm going to start advising clients maybe skip paying a bill and get a late payment or put less down because they're going to be able to get better pricing. Please don't do that. That is not what's going on. So what's the reality of what's actually happening? So what you saw in this chart is not what the new pricing is going to be. It's the change from the old pricing. So there are some adjustments being made. So why are they making those adjustments? What they're trying to do is increase the opportunity for home ownership. So in the last couple of years, it's really no surprise to anybody, but we saw hyper appreciation in prices on new home sales. We also saw a rapid increase in mortgage rates in the end of last year. They're starting to subside a little bit, but they're still obviously higher than what they were in pandemic levels and likely will remain much higher than they were in pandemic levels because that was an extreme anomaly. So what Fannie Mae is trying to do is redistribute some of those adjustments to make ownership more affordable without having the absolute top of the line credit score, without having the absolute top of the line down payment, because it's getting harder and harder for clients to do. So let's demystify this a little bit. Let's look at some real examples. Here at the top is an old level pricing adjustment. Down here below is the new updated one. So a couple things that you're going to see. On the old chart, you see that it used to take a 780 score to reach the top bucket. Now it's going to take a 740 score to reach the top bucket. But we go back to the chart a couple charts ago, and we talked about how, gosh, if I have a better down payment with great credit, it means I'm going to get a worse rate. No, you're not. Here's what it means: 75 to 80%. So that's a 20 to 25% down payment. If I had a 780 score, I would have a 3/8 adjustment higher on my rate. If I go to 75 to 80% now, I can do it with 740 score. I still have a 0.5% adjustment rate. So it is an eighth higher. But if you look at all the different lower scores that are in that bucket as I continue to move down that chart, it's not better than any of these lower scores. You can actually see if I had a 620 score, it's a 3-point add-on for that rate. Any of these scores with lower rates are higher add-ons. So it's not that you're getting worse pricing, it's just that the pricing is a little higher than what it was before. It went from 3/8 to a 0.5% add-on. In these buckets where you saw the real positive improvement there in the 720 range with 10 to 15% down, what you're noticing here is if I looked at a 720 score with 10 to 15% down, it was a 1% adjustment. If I came down here and I had a 720 score and I was putting 10 to 15% down, now it's only a 0.5% adjustment. So the entire net impact of all this is not that the pricing is going to be better if I have a lower down payment or better if I have worse credit. What they're doing is just trying to close the gap. If the rate was going to be, say, 2 points higher if I had a low score, now maybe it's only going to be 1.5 points. So it is not an inverted table. It does not mean that you should stop paying your bills. It does not mean that you should put less money down. Obviously, to each their own. You want to have a good discussion with a trusted mortgage consultant to make sure that you're looking at what fits you and the needs of your family the best, and maybe a lower down payment for what you're trying to accomplish financially does make sense, but it does not lead you to a better rate. The chart and everything that you see is all changes that happen from the previous chart. So people are publishing that as though it's the new pricing. It is not. The other important thing to know is these changes are happening on loans that are invested in by Fannie Mae as of May 1st. Well, lenders, when they close a loan, it can take you 30 to 60 days to package a loan over to deliver it to Fannie Mae. So, all that to be said, lenders have been aware of this change for months, and lenders made these changes to their pricing 30, 45, 60 days ago in preparation of the loans that we were delivering. Because if I closed a loan today at the old pricing and I delivered it to Fannie Mae next month, they would not honor that. I would have to eat that. So lenders knew this was coming. These are changes that have already been in play. Like I said, anywhere between 30 and 60 days, depending on the lender, these are already in play. So you're not going to see anything happening on May 1st other than what's happening behind the scenes on loans that are getting delivered into Fannie Mae. So if we look at it kind of down the chart, we'll do a quick recap here. We're looking at it's a change happening by Fannie Mae. It is going into play on May 1st, but it's something that lenders are already aware of and we've already made the changes on. So you as a consumer, consumers out there getting new pre-approvals, you're not missing out on anything if you don't do something this week. The next thing, and it's a really important bucket, pricing isn't better for lower credit or better for lower down payment. It's just better than what it was. So you're still getting premium pricing for that down payment. You're still getting premium pricing for that credit score. The gap between the top and the bottom just isn't as wide as it was. And really the why behind all this is we're trying to help with home ownership. So we're finding that with the rapid increase in prices and the rapid increase in rates, it made it harder for some buyers to be able to continue to afford to be homeowners. Well, now as the gap is shrunk down a little bit, hopefully that opens up homeownership opportunities for those around. I am happy to answer any questions that you have. I know this is a very important topic out there, and I look forward to talking to you all soon. Take care, everybody. Have a great one. Bye.